If there was one institution that is taking a direct hit from the prolonged slowdown in Nigeria's economy, it is the country's banking industry, and the effects are beginning to manifest in banks' balance sheet. The total amount of bad loans recorded by 14 Nigerian banks quoted on the country's stock exchange increased by a whopping 80% in the first 9 months through September this year. One bank, Stanbic IBTC alone, posted an increase of 521.33% in its provision for bad loans. Even the country's top 5 banks, who control about 70% of the banking industry loans, are not left out. The size of the bad loans of one of them is now worryingly approaching the central bank's threshold of 5% at over $200 million. Analysts Segun Akanji and Johnson Chukwu say the bottom line is that most debtors are finding it more difficult to meet their obligations to their banks, mainly out of no fault of theirs.
When you have a similitude of what you could call depression in an economy or a kind of recession, one of the key indicators would be that people will renege on contracts, because it means that people are unable to quickly access opportunities that would make them to be able to fulfill their obligation to institutions that they have contracts with.
We've seen a GDP growth rate of 2.35% in the second quarter of this year, and it's expected that that rate will even be further slow down or maybe maintain at currently at that level. So if that happens, companies will be unable to meet their payment obligations.
In August, Nigeria's central bank compelled lenders to begin to publish the names of their delinquent debtors, but that does not appear to have had much effect in bringing down the figures. Most banks are still heavily exposed to players in the oil industry, and with the price of oil still failing to pick up, Segun says the banks are finding it more difficult to recover their loans.
Beyond that is also to look at the energy power sector again, which banks have been heavily exposed to. The same challenge, because cash flows are not coming in.
Nigeria has seen a very sharp fall in its revenue as a result of the sustained fall in the global price of oil, which accounts for over 70% of government earnings. It's had to devalue its currency to preserve a depleting foreign reserve and put strict controls on its forex market. All of this have taken a huge toll on the economy, with local businesses badly affected.
We need to reflate the economy. We need to restore economic activities in the nation. We need to stimulate the local economy through expansionary monetary policies. I've always advocated that the federal government should encourage the Monetary Policy Committee to reduce the cash reserve ratio and the monetary policy ratio, such that lending to the real sector will become, if not single digit, at the lower end of its double digits, so that companies can be able to meet their interest payment obligations.
Despite the rising profile of the bad loans, the Central Bank of Nigeria says the country's banking system is still on a sound footing and that the size of the non-performing loans is still within an acceptable limit. But it says it is keeping a watchful eye on the situation to ensure things don't spiral out of control and throw the banking industry into a crisis the country can ill afford at this time. Deji Badmo, CCTV, Lagos, Nigeria.